Let me ask you a serious question. If the market crashes tomorrow, interest rates flip again, or AI wipes out half the jobs we know today, will your money be safe or exposed? Because 2026 is not about chasing hot tips. It's about positioning your money so it survives uncertainty and still grows. Ladies and gentlemen, I've studied markets through booms, crashes, bubbles, and resets. One thing is clear. The old investment rules are breaking. What worked 5 years ago won't protect you in 2026. Inflation behaves differently. Assets move faster. Risk shows up without warning. Tonight, I'm not here to sell you hype. I'm here to show you a practical, disciplined investment plan built for 2026. A plan designed to protect capital first, grow it second, and create real financial confidence in a changing world. When we talk about 2026, we are not talking about another normal market cycle. We are standing at the edge of a structural shift in how the global financial system behaves. For decades, investors could rely on predictable patterns. Interest rates moved slowly, inflation was manageable, and markets rewarded patience almost by default. That environment no longer exists. What we are entering now is a period where volatility is not an exception, it is the baseline. One of the biggest forces driving this shift is debt. Governments, corporations, and consumers are carrying levels of debt that have never existed before in peacetime. Servicing that debt becomes harder as rates fluctuate, and even small changes in policy can ripple across markets instantly. This makes traditional assumptions about stability far less reliable. What once felt like a safe long-term bet can now turn fragile very quickly. At the same time, technology is accelerating economic change at a speed markets are struggling to price correctly. Artificial intelligence, automation, and digital platforms are reshaping industries faster than capital can comfortably adapt. Entire job categories are under pressure, productivity is being redefined, and profit cycles are shortening. This creates opportunities, but it also creates sharp corrections when expectations move ahead of reality. In 2026, mispricing risk becomes a real danger for investors who rely on outdated models. Inflation adds another layer of complexity. It is no longer just a temporary spike that fades quietly into the background. Inflation behaves unevenly, showing up in housing, energy, healthcare, and food in ways that directly impact household cash flow and business margins. This changes consumer behavior, corporate earnings, and ultimately asset valuations. Money that appears to be growing on paper can still be losing real purchasing power. Global instability also plays a role. Supply chains, trade relationships, and political decisions now influence markets almost overnight. Capital moves faster than ever, and fear spreads just as quickly as optimism. This environment rewards preparation and punishes complacency. Investors who assume that tomorrow will look like yesterday are often the first to be caught off guard. All of this makes 2026 a turning point because it demands a different mindset. The market is no longer a calm ocean where steady sailing guarantees progress. It is a dynamic system where adaptability, awareness, and structure determine who preserves wealth and who slowly watches it erode. In 2026, the most successful investors will not be the ones chasing the highest returns. They will be the ones who understand that protecting capital is the foundation of every lasting investment strategy. Growth only matters if your money survives long enough to compound. In an environment where markets can turn sharply and without warning, ignoring downside risk is no longer aggressive, it is careless. Capital protection is not about fear or avoiding opportunity. It is about recognizing that losses hurt more than gains help. A portfolio that drops 40% needs far more than 40% growth just to return to where it started. That math has not changed, but the frequency of sharp drawdowns has. When volatility becomes common, recovery time becomes a serious cost that many investors underestimate. Another reality of 2026 is speed. Market reactions are faster, information spreads instantly, and price swings that once took months now happen in days or even hours. In this environment, having your capital fully exposed at all times leaves no margin for error. Protection creates breathing room. It gives investors the ability to respond rather than react, to make decisions from logic instead of panic. Inflation also makes capital protection more complex. Losing purchasing power quietly is just as damaging as a visible market crash. Money that appears stable but fails to keep up with rising costs is slowly being drained. True protection means preserving real value, not just avoiding short-term losses. Investors who focus only on nominal returns often miss this erosion until it is too late. Psychology plays a major role here. Investors who experience deep losses tend to change their behavior at the worst possible moment. They sell when fear is highest, hesitate when opportunity appears, and lose confidence in their own judgment. Protecting capital reduces emotional stress and allows discipline to stay intact. A strategy you can stick with is more valuable than one that looks impressive on paper. In 2026, growth comes after resilience. Markets will still reward innovation, productivity, and smart risk-taking, but only for those who remain in the game. Capital protection is what keeps you invested through uncertainty, gives you flexibility during downturns, and positions you to benefit when conditions improve. Without it, even the best growth opportunities can become irrelevant because the investor is no longer financially or emotionally able to take advantage of them. When you look at where serious capital is moving today, it rarely makes headlines. Smart money does not chase excitement. It positions early, stays patient, and focuses on long-term forces rather than short-term noise. In the build-up to 2026, this behavior becomes even more visible. Large investors are shifting toward areas that benefit from structural demand, pricing power, and adaptability in uncertain conditions. One of the clearest patterns is a preference for assets tied to real economic value rather than speculation. Capital is gravitating toward businesses and instruments that generate consistent cash flow and have the ability to adjust prices without losing demand. This reflects an understanding that inflation and cost pressures are not temporary inconveniences but ongoing realities. Assets that can pass those costs forward protect margins and investor capital at the same time. Another quiet movement is toward sectors that sit at the intersection of technology and necessity. Not flashy trends, but infrastructure that supports how modern economies function. Data, energy efficiency, logistics, and digital systems that reduce friction are drawing attention because they remain relevant regardless of market sentiment. These areas do not depend on hype cycles. They grow because society increasingly relies on them, even during slowdowns. There is also a noticeable shift in how risk is distributed. Instead of concentrating exposure in one market or one economic outcome, smart money is spreading across assets that respond differently to stress. This is less about chasing performance and more about managing uncertainty. Capital flows into places where volatility can be absorbed rather than amplified, creating smoother, long-term results. Geography matters as well. Investors are paying closer attention to regions with favorable demographics, stable policy environments, and long-term growth potential. This does not mean abandoning established markets, but it does mean reducing overdependence on any single economy. In a globally connected world, shocks travel fast, and smart capital plans for that reality. What ties all of this together is intent. Smart money is not guessing what will happen next month. It is aligning with trends that are likely to shape the next decade. The goal is not to look brilliant in the short term, but to remain positioned as conditions evolve. In 2026, the investors who quietly build exposure to durable demand, adaptable systems, and resilient structures are often the ones who appear calm while others are reacting. That calm is not luck. It is the result of deliberate positioning long before the crowd catches on. Diversification has long been considered a cornerstone of investing, but in 2026, it must be approached with far more intention than in the past. Simply owning a wide variety of assets is not enough. In today's markets, many investments are correlated in ways that are not obvious at first glance. You could hold stocks, bonds, and real estate, yet still be fully exposed to the same economic shock. True diversification requires understanding how different assets respond under stress and building a portfolio that balances exposure rather than spreads it blindly. It starts with recognizing that risk comes in many forms. Market risk is obvious, but there is also inflation risk, liquidity risk, geopolitical risk, and technology disruption risk. Diversification means creating a combination of assets that respond differently to each of these pressures. Some investments will perform when interest rates rise, others when growth slows. Some will gain from technological disruption, while others provide stability as a hedge against rapid change. The goal is not to eliminate all risk, no strategy can, but to avoid catastrophic loss when a single factor triggers widespread market reactions. Diversification also requires examining time horizons. Short-term movements can be dramatic, and assets that seem uncorrelated in one period may behave similarly in another. Building a diversified portfolio means balancing short-term liquidity needs with long-term growth potential. Investments must be chosen not just for their individual returns, but for how they interact as part of a larger strategy over multiple economic cycles. Another dimension of strategic diversification is geography. Economic, political, and regulatory conditions differ across regions, and global exposure can reduce the impact of localized shocks. However, global diversification must be selective. Investing blindly in foreign markets without understanding their unique risks can backfire. It is about finding the right balance between stability and opportunity across borders. Finally, strategic diversification demands constant monitoring and adjustment. Correlations change, policies shift, and markets evolve. An investment that seemed uncorrelated yesterday may move in lockstep with others tomorrow. Being diversified in 2026 means being disciplined, adaptive, and deliberate, not passive. It is a dynamic process designed to manage uncertainty while keeping growth potential intact. In this way, diversification becomes more than a rule to follow. It becomes a framework for resilience. It ensures that no single event can derail your financial trajectory, and it positions you to capture opportunity even in turbulent conditions. The quality of your diversification will determine how effectively you navigate the uncertainty and complexity that defines the investment landscape of 2026. Cash has long been underestimated in the minds of many investors, often dismissed as a low-yield, passive holding. In 2026, that perception is not just outdated, it can be dangerous. Cash is not merely idle money, it is flexibility, power, and protection. In a world where markets can swing dramatically, having liquidity allows you to respond strategically rather than react out of desperation. It creates options when opportunities arise and provides a safety net when markets turn unexpectedly. The value of cash goes beyond simply being available to buy assets at lower prices. It acts as a buffer against forced selling. Investors who are fully invested without reserves are often compelled to sell at the worst possible time during a downturn. Cash prevents this scenario, giving you the freedom to wait for conditions to stabilize. It ensures that you do not sacrifice long-term gains to meet short-term obligations, a mistake that erodes both capital and confidence. In addition, cash becomes a tool to leverage opportunities in uncertain markets. When others are hesitant, those with liquidity can act decisively, buying high-quality assets at attractive prices. This creates asymmetric advantages because you are effectively buying optionality. You are positioned to gain disproportionately when the market corrects or when unique situations present themselves. In essence, cash gives you the ability to turn uncertainty into opportunity. Managing cash effectively also requires discipline. It is not about hoarding, but about maintaining the right balance between liquidity and growth. Too much cash can erode wealth in an inflationary environment, while too little can leave you exposed to risk. The right allocation allows you to navigate volatility, respond to market shifts, and maintain confidence in your strategy without being forced into reactive decisions. Psychologically, cash provides clarity. Knowing you have reserves reduces emotional pressure, which often drives poor decision-making during turbulent times. It allows you to focus on strategy rather than panic, giving you the mental bandwidth to evaluate risk rationally and act decisively. Ultimately, in 2026, cash is not a passive component of a portfolio. It is an active instrument of control and resilience. It protects against downside risk, enables opportunistic growth, and preserves flexibility in an unpredictable world. Investors who underestimate the strategic power of liquidity may find themselves trapped by circumstance, while those who recognize its value gain a quiet but profound advantage in building and preserving wealth. In 2026, the difference between investors who succeed and those who struggle will come down to consistency. Markets are more volatile, information moves faster, and sentiment can shift in an instant. Without a framework to guide decisions, it's easy to be swayed by fear or greed. A rules-based approach provides structure in chaos. It removes emotion from decision-making, ensuring that choices are driven by logic and strategy rather than impulse. This framework doesn't guarantee every trade will be profitable, but it does protect against catastrophic mistakes and keeps long-term objectives in focus. Consistency begins with defining clear principles for investing. These principles cover everything from asset allocation to risk management, rebalancing schedules, and liquidity planning. When an investor knows exactly how decisions will be made under various conditions, there is no need to react to every headline or market fluctuation. This creates discipline, which is invaluable in markets where short-term noise can be overwhelming. Investors who lack this discipline often chase trends or panic during downturns, eroding capital and confidence. Another essential aspect of a consistent framework is adaptability. A rules-based system is not rigid. It allows for adjustments based on new information, market shifts, and changing personal circumstances. Flexibility within structure ensures that investors are neither overexposed to risk nor paralyzed by uncertainty. It turns volatility from a source of stress into a manageable factor, enabling strategic decisions instead of emotional reactions. Tracking and reviewing performance is also a key part of maintaining consistency. By measuring outcomes against the framework, investors can identify areas that need adjustment, reinforce behaviors that are effective, and avoid repeating mistakes. This iterative process strengthens discipline and builds confidence, making it easier to stick to the plan even when markets behave unpredictably. Finally, a consistent framework fosters patience. Wealth accumulation is rarely linear, and short-term fluctuations can be dramatic. Investors who rely on rules and structure are less likely to abandon their strategy in moments of stress. They understand that temporary setbacks do not define long-term outcomes, and they can stay invested in a way that allows compounding to work effectively. In essence, a rules-based framework in 2026 provides stability in an unstable world. It creates clarity, reduces emotional errors, and ensures that decisions align with long-term goals. By combining discipline, adaptability, and ongoing evaluation, investors position themselves to navigate uncertainty, preserve capital, and capture opportunities in a market environment that rewards preparation and penalizes impulse. As we look ahead to 2026, one thing is clear: the rules of investing have changed, and so must our approach. The market will not wait for anyone, and volatility will continue to test patience and discipline. But opportunity always exists for those who are prepared, who understand where risk lies, and who have a clear plan to navigate uncertainty. Protecting your capital, strategically diversifying, staying flexible, and maintaining liquidity are not optional. They are the foundation of lasting financial success. The goal is not to chase every trend or react to every market headline. True investing is about consistency, patience, and deliberate action. By focusing on what you can control: your strategy, your risk management, and your mindset, you position yourself to not just survive, but thrive, regardless of the market's swings. Remember, wealth is built quietly, over time, by those who combine knowledge with discipline. 2026 will favor the prepared, the rational, and the patient. If you commit to a framework, protect your capital, and stay strategically aligned, you are not gambling with your future, you are investing in it. The choices you make today will define your financial freedom tomorrow. Make them wisely, act deliberately, and the results will follow.